Okay, good morning, everyone. Am I audible? My voice is audible? Please respond, anyone. Third sim. Okay, 1 minute. సార్ మ్యూటేగా సార్ చేసేది వాళ్ళ వాయిస్ వినిపించకుండా సార్ సార్ మ్యూటేగా చేసేది వాళ్ళని సార్
ప్రాబ్లం ఏమవుతుంది
Okay, good afternoon, everyone. Okay, we discussing about different types of approaches regarding the capital structure. Okay, in previous class, in yesterday, we discussed about the net income approach, net operating income approach, and traditional approach. This is the another method that is Margulani-Miller approach, approach. So here, this approach we subdivide into one is without tax and second one is with the tax. Okay, this with the tax concept. This approach this approach is very big in next coming years. If you do any income or any PG or MBA, then you learn the detail regarding to this subject, this topic and this subject. So you know the just basic concept regarding this approach. Okay, this approach without tax. These are all the assumptions regarding this approach is described in perfect capital market, where there is no transaction cost and no taxes. The value and the cost of capital of the company remains unchanged. Okay, in this without tax concept, here the no transaction cost and no taxes and value of that particular cost of capital of company remains unchanged. Okay, this is the basic assumptions regarding to this approach. Okay, this approach based on further following additional assumption. This is the basic assumptions, and additional assumptions are 4. That is, first one is capital markets are perfect. Okay, all information is freely available and there are no transactions. Likewise, we discussed the same. Likewise, here mention the assumptions. This is okay. This is the valuation of method, value of the firm. So this is the formula for the value of the firm, that is net operating income by KO. KO is cost of capital. Okay, overall cost of capital, KO means. Okay, second is the firm having debt in its capital structure has higher cost of equity than an unlevered firm. Okay, cost of KE is equal to KO plus KO minus KD. So here each one is KE is a cost of equity, KO is cost of capital plus here same cost of capital minus KD is the cost of debt into debt divided by equity. This is the diagrammatic representation regarding this approach. Okay, the structure of capital, financial leverage does not affect the overall cost of capital. Okay, in previous approaches, first approach telling about financial leverage will affects the cost of capital. First approach they tell. Then second one is some point up to the certain level, financial leverage will influence the cost of capital. But now this concept is totally argues that financial leverage that not affects the overall cost of capital. Okay, that is why k is fluctuating here. Okay. In the this is the approach with the tax. Okay, in 1963 model was amended by incorporated the tax. They recognized that the value of the firm will increase or cost of capital will decrease. Okay, if value of the firm will increase, our cost of capital will decrease. Sorry. As a result, there will be some difference in earnings of equity and debt holders. In levered and unlevered firm, the value of levered firm will be greater than the value of the unlevered firm. See, the value of levered firm will be greater than the value of unlevered firm. Okay, unlevered firm is greater than the levered firm. Okay, this is developed by following formula for computation of cost of capital. Okay, earlier we discussed about the without tax. Here they includes the tax also. So value of levered for company equal to value of unlevered company plus tax benefit. Okay, VU is the value of unlevered firm. TB is a tax benefit. Okay, second one is cost of equity levered company. This is the formula for second thing, levered firm and unlevered firm. This is the problem and solution regarding to the approach. So see these, there are two companies, N Limited and M Limited, having same earnings before interest and tax. EBIT is the same for the both M Limited and N Limited. Okay, M Limited is levered company. Okay, and having debt is 1 lakh at the rate of 7%. The cost of equity N Limited is 10% of M Limited. Is okay. N Limited is 10%, and okay, and M Limited is 11.50. So based on this, we calculating the one. Sorry. Okay. Okay. Based on this, there are two companies. One is M Limited and second one is N Limited. So they that EBIT regarding to both companies, that is 20,000, 20,000, and one is not having the debt value, another company having the debt. So at the time of not having the debt, Unlimited not having the debt, how much return they got, and Unlimited having the debt value, debt capital. So how the returns to be increasing or decreasing regarding to when using the debt values. So the value of the equity is net operating income minus interest, that is 20,000 minus interest. How much is KD for that is 7%, and by cost of equity. See the second one, that is 20,000 minus 7,000. 7,000 is the interest divided by KE percentage already they are given, that is 11.50. So the value of that particular company is 1,13,042, and End Limited, they don't have any debts. Okay, so that is why how the company is earning, how much money is a company earning, that is total amount belongs to that particular owners and equity shareholders only. So how much it is, that is 20,000. This 20,000 is entire amount goes to went to that particular equity shareholders only. How much it is? 2 lakhs. So when we using the debt at some percentage, and when we do not using the debt, the same situations, equity shareholders value increasing. Second thing, in companies that the equity shareholders value is increased, and compared to M Limited, okay, M Limited has less uh, value. So the total value of the firm is S plus D, that is M Limited has 1,13,043, and debt value is 1 lakh, that is 2,13,043. So this is the value of M Limited, this is the value of N Limited. When we use the optimum level of capital structure, so that time equity shareholders get the more returns compared to the uh, other things. And when we using the optimum level, for example, here they are M Limited using the debt values, so the debt holders, they get only interest only, but equity shareholders get this share in the profits. Here N Limited only having equity shares, so they are not getting the higher returns. Why? Because all are equity shareholders only. So this is the concept regarding to the approach. Just you read, everything is contained in our books. Okay, up to this we concluded this chapter, that is capital structure. Okay, next one is working capital. Okay, 2 minutes. Okay, so this is next chapter. Okay, we're discussing about the working capital. What is mean by working capital? Working capital is, in accounting terminology, working capital is difference between the current assets minus current liabilities. For example, X Limited having the current assets 1 lakh rupees and current liabilities 20,000. In between, current assets minus current liabilities means 1 lakh minus 20,000. 80,000 is the working capital. So it is an accounting terminology. So why we learn this chapter? Why we are learning this chapter means, for maintaining the working capital, we are for using the working capital effectively. Okay, effective use of working capital. So this working capital, after learning this working capital, we know the determinants of working capital. Okay, after learning this chapter, we know the determinants of working capital. And second point is estimation of working capital, how much working capital we required. Okay, any excess amount of blacked in the working capital, so we will estimate the, after learning this chapter. Okay, and what is the working capital cycle? It is first how many days it completed for working for one circle. And inventory management means like uh, and pay debtors management, and payables means we are paying some amount to the creditors. So, and finally, financing of working capital, any instant cash. Okay, we learn this all things. One is working capital cycle, second one is inventory management, third one is payable management, fourth one is financing of working capital. So we learn about this all concepts. Okay, see the which items comes under the which head, that is we discussing about the two things. One is what is mean by current assets, and second one is current liabilities. So in the first term, What is mean by current assets? Current assets means this is used for only within 1 year, within short period of time. These assets are used for only within short period. Okay. Uh, uh, so see the definition regarding this current assets. It is expected to be realized or instead to be sold or consumed in normal operating cycle of entity or within 12 months. Okay, within 12 months, this raw material, anything, this is used within 12 months, reporting period whichever is okay, longer within 12 months, uh, we call using this material, so we call it as a current assets. So main primary objective of this current asset is the asset is held for primary for the purpose of trading in the ordinary course of business. So our business process is not stopping anywhere, is uh, going continuously. That purpose only we are maintaining some liquid or some in that particular company, or some raw materials. We blacked our uh, some amount in raw materials, and some we are giving to the our products to debt basis, and some we are purchasing the some material from the outsiders, so we are paying some amount to the outsiders. So these are all the money blocked in certain time period, that is 20 days or 30 days, depending upon our processing or production process. Okay, so the for purpose of working capital management, current assets of an entity can be grouped into the following categories. So current assets we classified in the below categories. One is inventory, first one is raw material, work in progress, and finished goods. How many days it will take uh, for the purchasing uh, branch to our production department, how many days it is taken, and on that time our money uh, is in our money in that particular in that particular raw material. So working progress, sorry, and receivables we call it as a debtors, and cash equivalents, this is also one current asset. And the prepaid expenses means we are paying advances, we are getting the uh, materials before we paying some money, or we are paying advance, we will call it as a prepaid expenses. And current liabilities are the below. Current liabilities are cu- current liabilities are sundry creditors and any other outstanding liabilities. Okay, overdrafts. These three are the other current current liabilities. Okay, working capital. Working capital is a process which is designed to ensure that an organization operates efficiently by monitoring and utilizing its current assets and current liabilities to the best effect. Okay, we are using the current assets and current liabilities in best manner, best effect, best utilization. Then we will get the benefit, but benefit on the base of best usage of current assets and current liabilities. Okay, the primary objective is to enable a company maintain sufficient cash flows in order to meet in the day-to-day operating expenses. This is a general definition regarding to the working capital management. That is, primary objective is to enable the company maintaining sufficient cash flows in order to, why we maintaining this working capital management means we maintaining this working capital for sufficient cash flows in order to meet the day-to-day operating expenses. It is like, it is not, it is only for short term purpose only. Okay, this concept capital can be explained in two angles. One is on the basis of value. Value means we are using some uh, we are using the quantity and price of that particular product, that is gross value. Second one is net value. Based on this gross value and net value, we will categorize categorize the value basis, and second one is on the basis of time. Okay, some working capital in fixed nature. Every time, every day, in our account, we maintain the 1 lakh rupee for meeting the day-to-day expenses. That 1 lakh is the permanent working capital. Okay, but that working capital is that working capital is maintaining for the perfection in nature. So when the amount is decreased, we will add up the amount to the that particular account. Okay, that is the permanent working capital. Fluctuating working capital means when we will require that time only we adding the money. Some day it is 1 lakh, and some day it is 1 lakh 20,000. It is depending upon our need, we maintaining this particular fluctuating capital. Okay, some of the factors which is need to be considered while planning working capital requirements. Okay, for uh, for planning the working capital, these are all the points regarding to the working capital. So we consider this all the factors for how much working capital we required. That is, one is cash, and second one is inventory. Inventory means like raw material, working progress, and likewise raw material, working progress, finished goods. And receivables means it is like a debtors. We are giving we are giving the products to the other supplier, other users, our customers, on the basis of credit basis. So that is, we call it as a receivable. We get the sum after completing of 10 days or 15 days, or what is our norms. Based on our norms, we receiving that money. And short-term financing options. Short-term financing options, here we discussed that that is treasury bills, and bills receivables, bills payables, and short-term call money. Like the some of the examples of for this short-term financing options. Nature of business. Working capital is depending upon our nature of business also. Some working capital, some companies have more working capital for maintaining the day-to-day expenditures. Some working capital is required less for some companies. So it is depending upon the nature of the business and market and demand conditions. And also for some our production is increased. For example, our production is mainly in 3 or 4 months. In particularly last 4 months, it is, for example, in the 9th, 10th, 11th, 12th, these 4 months our products have more demand. For example, we are producing the uh, AC coolers, like we, in the summer season, our products have more demand. Okay, that that is also our production department also requires more money on that particular time. So it is depending upon the market and demand conditions. Next one is technology and manufacturing policies. And depending upon our technology, our production, depending upon our production things, also working capital is required. And operating efficiency, we have efficient workers and efficient equipments. Based on that also our working capital is changing. Price level changes. Some raw materials have fluctuating every day. So depending upon the price level changes also, our working capital is changing. These are all the factors regarding to the we consider in mind and prepare the working capital, maintain the working capital. Okay, this is the first concept regarding the working capital cycle. First, for example, we have a 10 lakhs rupees in our hand. That is cash. That is how much cash we have. 10 lakhs rupees. On the 10 lakhs rupees, we purchase some raw materials and we paying to the laborers. That is 5 lakhs rupees. Okay, we are purchasing how much quantity of raw materials. That is 5 lakhs worth of raw materials we are purchasing. Then this process to next, that purchasing materials were sent for production department. That is, it is under the process for completion of final product. Okay, after that working progress, completing the products. After completing of the product, we call it as a cost of goods sold. So that we are maintaining the stock in the go down. So after completion of products, full products, we distribute that products to the our retail stores. Then that retail stores sells our products, some on the basis of cash basis, some on the basis of credit basis. So we sell the products on the basis of credit basis. So debtors give that amount receivables. Receivables means in this receivables we have cash and credit. We are credit basis. So this is the circle. This is the circle regarding to the working capital. In this 5 steps only, our working capital is required, and every year, every process we require the some working capital. Okay, this is the equation for the operating cycle process. In the form of equation. Okay, in the form of equation, operating cycle process can be expressed in the following follows. That is, operating cycle equal to R means raw material storage period, and W means working progress inventory, and F means finished goods, D means debtors, and the final one is C is a credit period allowed by the suppliers. We are purchasing here, last thing is we are purchasing the raw material from the outsiders. So how many days they are give to us to repaying the amount. So we will call as the, this is the operating cycle. Okay, this is the formula for the operating cycle. Okay, this is the formulas for individually. Okay, the various components of operating cycle may be calculated as below. For raw material storage period, how many days or how much cost we incurred for storage of for particular raw material storage. That is, average stock of raw material divided by the average cost of raw material consumption per day. How much? 1 minute. Okay, this is the formulas regarding to the so this is the operating cycle may be calculated as on below. First one is raw material storage period. How many days we are storing the money? We are our money blocked in the raw material. So how many days or how much money uh, we are spending in that particular raw material storage period. So how we will calculate it is equal to average stock of raw material divided by average cost of raw material consumption per day. How much raw material we are consuming every day and average stock of raw material. How much raw material we have and how much stock of raw material we are consuming. So this is for the raw material storage period. And the second one is working progress inventory holding period. How many days or how much amount we blacked in that working progress process. That is, it is average work in progress of inventory divided by average cost of production per day. And finished goods, likewise we are calculating the uh, different components of operating cycles are in the different formulas. Okay, this is the example problem for the working capital operating cycle period. Okay, from the following information of XYZ Limited, you are required to calculate the net operating cycle period and number of operating cycles in a year. Okay, this is the example problem. Based on that, we will understand. Okay, first one is raw material inventory consumed during the period. How much money we are spent for a year for raw material, that is 6 lakhs, and average stock of raw material. Okay, how much stock of average stock of raw material is 50,000 rupees, and the work in progress inventory is 5 lakhs, and the average of work in progress inventory is 30,000. Fifth one is cost of goods sold during the year is cost of goods sold value is 8 lakhs, and the average finished goods stock held is 40,000. Seventh one is average collection period from the debtors is 45 days, and average credit period availed is 30 days. Number of days in the year is 360 days. So based on this information, we will calculate the net operating cycle and net number of operating cycles in a year. Okay, net operating cycle period. Period means how many days it will takes to for uh, one process, one cycle, how many days it will take. And second one is number of operating cycles in a in particular year, how many cycles are taken, how many times we are this process is continuing, how many times. So based on the these formulas, we will calculate the net operating cycle period. Okay, first one is raw material storage period. Average stock of raw material storage, that is how much it is 50,000. Okay, 50,000. Okay, this is the 50,000 average consumption, average stock of raw material. And the second one is 6 lakhs for raw material. How many days we are using raw material for, we are how much money, that is 6 lakhs rupees we are spent for 1 year for purchasing of raw material. So we have for only 1 day, so that is divided by 360. Then we will get the per day how much money we are spending spending on raw material is 1000 and 1667. Okay, this is per day. For we are spending per day amount, that is on each day how much money is 1667 rupees. Okay, average stock period is 50,000. Okay, this is how many days it will take means 30 days. Okay, this 50,000 this 50,000 rupees is manageable. With this 50,000 rupees we will manage the working capital on raw material, that is 30 days we will manage. Okay, likewise working progress inventory holding period, how many days it will take for working days, work in progress, that is how much money we have, that is 30,000 we have average working progress inventory. Then average cost of production per day is 5 lakhs divided by 360, that is how per day 1389 rupees we have for maintaining the working progress. Okay, this amount is how much, this amount we will manage the up to 22 days only. So finished goods storage period is same, likewise we will calculate, then we will get the 18 days for finished goods. The last one is that is receivables debtors collection period, how much time we will give to the debt holders. Okay, we are selling the products to the outsiders, a particular outsiders, then we will with repayment period is 45 days, and credit period allowed by the creditors. We also purchasing the materials from the outsiders. They are, how much time they will give to us, that is 30 days. This is the circle, this is the net operating circle, and this is the formula. Okay, raw, for the raw materials, how many days work, how many days it will take, that is 30 days, and progress is 22 days, and finished goods for 18 days, debtors is 30 days, 45 days. So this is the gross working capital. That is that is 30, 22 days is 52 days plus 18 days is 52, 52 plus, okay, then 18, 60, 70, and 45. 115 is the gross working capital, and then we will deduct this 30 days, then we will get the net operating cycle. This is actual, uh, we will maintain the working capital, we will use this net working capital. Okay, number of operating cycles in a year means, in a year how many days it is, 360 days, divided by operating cycle. Our operating cycle is 85 days. So how many times we require working capital is 4.23 times we will require the working capital. This is the working capital. This is for, this is the working capital life, operating cycle method. So we will discuss about the other concepts regarding to the how much money we required for working capital, and uh, how we will calculate the debtors value and the creditors value, and uh, for cash also. So we will discuss about this regarding other working capital things, we will discuss later. Thank you.